Hello and welcome to Signal or Noise, Livewire's show dedicated to the intersection of economics and investing. We are about to enter the most important month on the calendar for Australian investors, August full-year corporate report season. And investors really will be going into this month with two key questions in mind. One, will we see a good enough earnings season to keep the ASX 200 at its record high levels? And two, which companies will still be able to grow earnings even in this tough economy? To discuss this and the other issues surrounding the full-year reporting season, we have assembled a panel featuring three of Australia's best investors, and I'm happy to say, Signal or Noise returnees as well. A warm welcome back to Aaron Binstead, Portfolio Manager of the Australian Equity Strategy at Lazard Asset Management. Similarly, delighted to have David Cassidy, Head of Investment Strategy at Wilson's Advisory. And of course, it's always terrific to have Dr. Shane Oliver on our panel, Chief Economist and Head of Investment Strategy at AMP. Gentlemen, welcome. Good to see you.
Thanks, Hans.
Before we get to the next 4 weeks, I thought it'd be instructive to look at what happened 6 months ago. And we'll start with the big data point, which also shows up in this chart from CommSec, which is that just over 80% of companies made a profit in the last half. That's from the ASX 200. Now, that sounds good until you realize that is both well below the long-run average and it has been on the decline for the last 3 or 4 reporting seasons or so. But of course, that only tells part of the story. Let's go through some other numbers. Profits fell by 35% on aggregate during the February season, although 70% of companies beat or at least met analyst expectations. And then when we look forward to what's coming up in terms of forecast for this coming month, UBS data suggests full year 24 earnings will fall by 3.5% on aggregate, adding to full year 23's 2.9% decline. But next year, Macquarie's data suggests earnings will rebound by about 10%. Now, it's important to know that while every research team does have different specific forecasts, the general big picture message of earnings declines this year and a rebound next year is the same. So, here's the big question panel, and Shane, I'll kick off with you. Do you expect the August reporting season will finally produce the bottom for struggling earnings growth? Or do you see the current macro environment signalling an even tougher road ahead for corporates? Signal or Noise, Shane?
Well, that'll have to be Signal. This is an important reporting season. As you point out there, we did see falls in profits in the last financial year. We're probably going to see falls in profits for this financial year, so that's 2 quarters in a row after the so-called sugar hit, the stimulus boost, the reopening boost back in 21-22. So it's quite an important reporting season. I tend to think this probably will be the bottom. A lot of stocks going through a lot of pain, some coming off those highs from a couple of years ago. As we head into a world of lower interest rates, it'll take a while to show up, but I reckon through the next financial year, the financial year we've just entered, we will start to see profits starting to lift again. Maybe not as strong as the 10% number you referred to there, but maybe 5-6%, something of that order.
Okay. Well, Shane, you referred to how just crucial this reporting season is. Why don't we talk about that in respect to the chart that you brought along, sir? We're talking about equity risk premium over bonds. Why should this matter to the everyday investor, and why specifically for this earnings season? Well,
that chart is a fairly standard valuation measure. It's not necessarily the best, but it is one of the simplest and one of the easiest to understand. It compares the yield available, the forward earnings yield available on shares against the bond yield. And obviously, the higher the better. And some people call that the risk premium. But what you can see is that both for Australia in blue and the US, which is in red, hopefully I've got those colours correct, there's been a decline recently as bond yields have gone up to higher levels and share market's gone to record highs, but we've got soft earnings. So we really do need to see some decent earnings starting to come through. Otherwise, at some point, investors might say, well, we're not getting enough of a risk premium here, and ditch share markets and you get a bigger fall. You can still have a correction, but you really want to see decent earnings growth starting to come through, or at least confidence that we've hit the bottom and those forecasts for stronger growth in this financial year and beyond that are going to be realised.
Yeah, absolutely. All right, thank you, Shane, for bringing that along. Aaron, is this the bottom? Signal or Noise?
So I'm going to say on the equity risk premium, it is a signal, but in terms of reporting season, it's completely irrelevant. Measures like this are really more long-term valuation measures. You would no way try to use that to position within a month or a quarter, or I'd even say a year. But on a longer term view, absolutely, what you can get risk-free, you do want to get a premium for equities, and right now that's just not there.
Okay, but in terms of this specific earnings season that we're coming up to. Will it finally produce the bottom for earnings growth, do you think?
So that depends what's going to happen to commodity prices. You referenced what happened last reporting season. 3 GIG sectors out of 11 were negative, the rest were positive. 2 of those were energy and materials. Guess what? Oil price and iron ore, they're very large profit contributors for the ASX 200. They will dictate what happens to the market, but that's arguably not that relevant to the underlying economy in terms of what's happening in the domestic economy. And indeed, most companies can still go okay if the energy price and the iron ore price are not doing that well. So I'm saying I don't think that's a big driver for the upcoming reporting season outside those very large specific sectors.
David, where do you sit on this, signal or noise?
Oh, I'd call it a weak signal.
Okay.
I think from the perspective of the market, you'll probably see a mathematical bottom in terms of overall earnings growth. But I think the thing is, if we get an upturn, it's relatively anemic in my view. And I agree with Shane that 10% estimate would tend to put it at mid to low single digits to the extent we get a rebound in FY25.
Okay. Let's move to sector specifics. Aaron's already alluded to it a little bit, and we'll talk about resources now, because of course the most consequential sector that reports in this February and August period generally are the resources companies. A, because they make up 20% of the index, and B, because most of the banks, apart from the Commonwealth, don't report in cycle. Earnings in this sector have been coming off cyclical highs. Again, as Aaron mentioned, talking about iron ore, due in large part to the fact iron ore prices down roughly 25% year to date, and that prices for key export commodities like lithium have dropped considerably. Lithium prices down 70% in the last 12 months. But this is where it's about to get interesting, and let's bring up this chart from Morgan Stanley. The forward price to earnings multiple, PE, multiple for resources companies is now 20% cheaper than the long run average, and the performance gap between the banks and resources is at its widest for a long time, and I have no doubt that that'll be slightly more exacerbated today because CBA officially today, as of the day that we are taping this, became the most valuable company on the ASX, even in front of BHP. And for what it's worth, Macquarie's data also suggests that the consensus thinks resources earnings could grow by 23% in fiscal 25, which is pretty punchy. So, and Aaron, I'm going to turn to you first on this one. Is this all a signal that resources stocks could deliver some big upside surprises this August? Or is it all noise, signal or noise?
So absolutely a signal, although I wouldn't say not so relevant for this specific reporting season, but in terms of a long-term valuation call between the two sectors, absolutely a signal. Although again, within resources, you do have companies that are moving in different ways, and you want to be specific, but signal absolutely.
Okay, Aaron, speaking of that, let's talk about your chart. And in this case, we're talking about a specific resource, which is met coal. So why is this chart important to you specifically in the context of this sector?
Look, it's quite a niche commodity market, but we think it's very exciting on a medium-term view. Really simply, you've got demand growth being driven by India. Blast furnace steel operations crossed about 160 million tonnes at the end of last year. By 2025, that's going to surpass 200 million tonnes, and the government, while it's maybe a bit ambitious, is looking to get past 300 million tonnes by the end of the decade. There's no supply growth. Australia is the largest supplier of seaborne met coal. In 2023, we shipped 20 million less tonnes than we did in 2019. This stuff is very hard to get hold of, and demand is growing, which basically means more profits for incumbent suppliers. But the market is valuing them on very low multiples. So there's going to be some volatility, but we think on a medium-term view, it's very attractive.
Okay, so for those who may not be accustomed to knowing their resources stocks well per se, are there any ways to play that through the ASX? They maybe Whitehaven is one of them.
So Whitehaven did, because it's now majority met player, given they bought some mines from BHP. That's the main one. There's Coronado is another one, and Stanmore are probably the most liquid, easy to play names there.
Okay, so David, turning to you now, if you look at that chart and that performance gap being at extreme levels between the banks and the resources, do you think there is a signal there that resources stocks could deliver some big upside surprises this August?
Not so much big upside surprise from resources, but I think certainly concerns from our perspective that the banks are overvalued here. We don't really think it makes sense that the banks, particularly CBA, have been as strong as they have been. I think part of it is probably some money just seeking some apparent safety for moving out of resources on concerns around China. But I think the issue is that money actually going to be safe in paying really big multiples for banks, particularly Commonwealth Bank at the moment? So I have my concerns that in seeking safety, the market has pushed banking valuations to unrealistic levels.
On that, a small follow-up question without notice. Is that exclusively a CBA problem, do you find, or is that an issue for all the banks that they're just so expensive?
I think initially we had the view that it was more a CBA problem, but as the banks have rallied as a group, we're to some extent worried about valuations right across the sector. I think CBA is the poster child for overvaluation in my view, but we don't really see great value in the banks as a sector at the moment, given how strongly they've run over the last 12 months really.
Shane, over to you now. What do you make of this idea that there is not just a big performance gap to make up as well? Obviously, the panel are finding all sorts of different signals in this particular chart, but just this sector, which is obviously so important to our economy as well. Do you think it could deliver some big upside surprises this August?
Not necessarily in August, but I think over time it will. There is some signal in the chart there, I think, regarding met coal demand coming out of India, which we're also focused on China, almost blindly focused on China, and we often forget that we will move on. In time we will move on, like we moved on from Japan or the UK, Australia will move on. And the growth in metallurgical coal demand coming out of India, combined with the growth of India. I mean, India is now the world's biggest country by population. It's got stronger growth than China as per capita GDP comes from a very, very low base, and it's gradually industrialising. It sort of started becoming a service economy before it became an industrial power. So I think there's a huge signal there on a medium-term view. There is life after slower growth in China, particularly for our resources stocks.
Okay, so that's interesting. So you find a signal in Aaron's chart, but for this particular context and this particular topic, would we classify you more as noise because you don't think that it's a big upside surprise for resources stocks specifically for this coming month?
Yeah, look, potentially I think it is. Okay. And I am conscious that, when you look at profitability, the resources have been down here in a bit of a hole. Banks have been a little bit slower as well, but sort of the market has been less concerned about what's going on in the bank. So I'd have to say there is a potential there for a reversal. So in that sense, you'd say there is a potential signal there as well. But I don't have a overly strong view on whether that will come to pass in the August reporting season.
Sure, fair enough. It's another weak signal, I guess.
Yeah, weak signal.
Fair enough. For our third segment, we're going to trial something new. Normally, the guests on this show bring the charts. I mean, you've already seen Shane and Aaron's, and David's is coming up. But today, I'm going to be the one asking them to identify the signal in the chart. We're going to show a chart to the panel, and we'll ask them if they find any signals from the chart that we are about to show them. And of course, if they don't find one, we'll classify the chart as noise. So panel, here's the chart. It's from Shaw and Partners. And their argument here is that despite all the talk that the banks are super expensive and struggling for margins, pertaining again to what David was saying just now, it is still the sector with the highest earnings revisions ratios, and by a long way too. Now, for those of you who are watching this and can read this also in the accompanying wire, you can also see the revision ratios for resources companies and industrial companies. Now, that's both cyclical and defensive oriented. So, David, I'll come to you and I'll show you that chart again. Do you find any signals in this chart? And if so, what is it?
I think it's noise, Hans.
Okay.
I think we tend to measure revisions a little bit differently. I think that chart shows the number of bank stocks that are seeing upgrades versus downgrades, but it's not telling you about magnitude. So for instance, we look at CBA, it's had an upgrade in the last 3 months, but it's 1%, and the stock's up 20%. And if you look at a 12-month view, pretty similar story, very low double-digit upgrades, but 40% performance. So from that perspective, even though there's been a slight, fairly consistent tendency for upgrades in banks, very, very small upgrades, whereas the share prices have leaped ahead. So I think really what's happening with the share prices are, they're telling you the market expects more upgrades. And if we don't get them, particularly with that CBA result, I think there's downside.
Okay. Well, David, let's go through your chart now while we talk about it. Now, this chart's going to feature about 30 stocks, but don't worry, readers and viewers, you don't have to squint because you're not trying to eye a singular stock in this chart, but rather a big picture theme, which is what, sir?
Yeah, well, what I've done here is taken the 30 largest stocks in the Australian market by market cap. And I think what you see here is, even though we've got a weak overall market growth estimate for FY24 of, let's call it -5, when you look at the chart, it's quite diverse. So despite the story around market doesn't have earnings growth, when you look at even the large caps, not to mention mid caps or small caps, there are still quite a lot of large cap companies in the Australian market that will deliver perfectly good earnings growth in FY24. So from that perspective, this idea that there's no growth in Australia is not actually right. Now, of course, you've got to go the second layer and say, well, how's this growth being priced at the moment? How are valuations? But there's certainly growth being delivered both in FY24 and we think FY25 within the Australian market. You just got to look for it at the stock level.
Yep, okay, absolutely. Thank you, sir, for that. Shane, I'm going to pose the same question to you about the Shaw and Partners chart here, specifically around the earnings revisions ratios. Do you find any signals in the chart, or is it noise?
I think it's a weak signal. It sort of relates to what we were talking about in the previous section, and that is that resources have been seeing the downgrades, the weak profits, financials, weakish profits, but nowhere near as weak, but more upgrades. So at some point there'll be a mean reversion there. That chart does cycle around. So at some point the one at the top, which I think is financials, will come down, and the one at the bottom, which has tended to be resources, will go up. And that in turn might tell you something about the relative performance of the what's going on beneath the surface in the Australian share market, which that will go through a period where resources are back in favour again. I don't know that it's going to become apparent in this reporting season, though. I think it might be a little bit out there before that really starts to kick in.
Yep, all right, well, we'll keep an eye out on that. Aaron, do you find any signals in the chart, or are you a noise on this one?
I'm going to ratchet up another noise call here, and the key reason is context. So from about December 23, we have seen the banks GIC sector have about 5% positive earnings revision. But if you look in a wider context, it's still down 12% from December 22. So it's overall negative, slightly less bad, but from that December 20 point date, I should say, prices are up 20%, while EPS is down 12. That's really not that inspiring. And in fact, when you look at the bank sector, it actually really hasn't shown you any growth for a decade. So I'm going to say that short run data point is noise.
The importance of zooming out, everybody. All right, given this is our reporting season episode, we couldn't not squeeze a few stock and sector picks out of the panel before we go. So let's do that. Aaron, let's start with you. I wonder if you could tell us about a couple of stocks you are watching specifically this reporting season and why.
Yeah, absolutely. So I thought I'd pick two that have been in a bit of trouble and reasons why it might be worth paying attention to. So one is Bapcor. We know that they've had some downgrades. The reason this is interesting is the key driver of the downgrades has actually been internal cost escalation. The top line has slowed, but it still kept chugging along, but management has piled in a lot of cost and led to profit downgrade. The recent previous interim CEO, who's now moved on for a permanent CEO, has said that he was going to start to focus on those costs. Low expectations there. If they can show any progress that costs are coming down, I think that could be relevant for the share price. Second one, another company that's had been in quite a spot of bother is Domino's. The reasons why that is interesting: they downgraded in January, share price down 30%. They downgraded in April, share price down mid-teens. They downgraded in July, share price down around 8%. It looks like we're finally kind of having a basing. We're finding a bit of stability. If management can convince the market there's some degree of solid base going forward for FY25, I think that could be interesting for Domino's.
Small follow-up question without notice for you. I know you and the team have been really focused on insurers over the last year, certainly, and a little bit more than that. What do you think of the prospects for those companies like IAG, QBE, Suncorp, those big three?
They're in a good place. Premium momentum is strong. We actually think that there's good earnings growth in the bag into 25. That has not changed. The only thing that's changed is the share prices are starting to reflect that a little bit. So the risk reward, perhaps is not quite as attractive as it was, but earnings still there, really positive, happy to hold.
All right, thank you, sir. David, what about you? Maybe 2 or 3 stocks that you're watching this reporting season and why?
Yeah, Hans, one we like from a profit perspective is CSL. We think if you zoom out and look at the CSL chart over the last sort of 4 years, it's been in a bit of a range trading environment, really struggling to break out of that range. It's been picking up recently, but we think it will report well in August. We think there's a building margin story there. We think there's a strong margin recovery over the next 2 or 3 years in terms of its core business, Behring, the plasma business. Collection costs are coming down again post-COVID after a period of elevated collection costs. Productivity is going up within that core business. So we think the result from CSL and the guidance will be strong. So it should allow it to break out of its range. You've stolen my thunder on the other one. I was going to nominate IAG on the back of that insurance thematic. I think that's going to be a very strong result. Everyone can relate to the fact that insurance costs are going up.
Yep.
You're probably getting pretty close to a peak there, but I think it's yet to be fully reflected in profitability. It'll take a while to come through, and quite possibly we see some strong capital management as well at this result. So happy to continue holding IAG.
Yeah, well, and IAG on your particular chart really stuck out like a sore thumb on that left-hand side of the chart. So I can't blame you for picking that, sir. Shane, I know you're an economist, so you don't per se pick stocks, but with your macro brain on, is there a sector that you are watching over the next 4 weeks that's of importance to you?
Consumers.
Yep.
That's what 70% of the Aussie economy is consumer spending, so it's critically important to the economy. Households have been under a lot of pressure. So far, you could argue that retailers haven't done too badly, partly because there's been more of us. We've been importing people, so that keeps things going in a nominal sense, and their prices have gone up, so that sort of made up for it to some degree. But there's obviously a lot which will be quite critical going forward. You've got the positives from the tax cuts, but you've still got high for longer interest rates, and we've got a negative potentially coming through as population growth goes from, say, 2.5% down to maybe 1.5% or less. So I think consumers and how they're handling this period and the outlook, what the retailers are seeing regarding the outlook, is critically important.
I find it amazing we didn't mention interest rates until the end of the show, but that's the way it is. That is the Signal or Noise reporting season show. A big thank you to a terrific panel, to Lazar's Aaron Binstead, to David Castley of Wilson's Advisory, and of course to Dr. Shane Oliver of AMP. Thank you, gentlemen, for all being here. Really appreciate your time and your insights. We'll see you in 2 weeks, and speaking of the consumer, our next show is actually dedicated to the Australian consumer. Is it really as resilient as everybody says it is? If you've enjoyed the program, please do subscribe to the Livewire website, as well as our YouTube channel and our podcast, and we'll see you in 2 weeks for the Consumer Show. Thanks for joining us.